Hey guys, welcome back to the Patty Martin Real Estate Group YouTube channel. My name's Adam Wachtel, and today we're taking a look at the last segment of our investment property series, and we're going to be looking at a cash flow analysis that's going to project out 10 years to see how your investment is doing. So we're going to look at a straight rental of a typical one-bedroom property, and then we're going to get into something a little bit more in depth where we're going to look at a house hack and see if this is something that could work for you. So let's dive in. So guys, let's first look at a typical one-bedroom rental as if you were going to be the landlord, just renting it out to a arm's length party. It's a one-bedroom property. So let's dive into what some of the numbers look like. So a one-bedroom property, let's go into a area that we know is going to grow in value, that's pretty reputable. We're probably looking at about a 25-year-old one-bedroom in Kitsilano. Let's assume this price is probably going to be somewhere around 650 to 700. You're going to get a lower end property for that value, but let's use some of those numbers. So first, we're going to be looking at our property price. We're going to plug in 650,000. We have to account for transfer tax right after that because, of course, the government needs their piece. In order to make any rental property work in the city of Vancouver, just because the prices are as high as they are and the rents are, I mean, they're high, but they're not as high as we need them to cover the entire cash flow. You're going to need somewhere between 40 and 60% as a down payment just to cover your cash flow, just to break even. So here I'm going to assume that we're going to be putting $300,000 down and then only be taking a mortgage of $361,000 at about 6% interest in today's environment. I've had a couple investor clients right now that have locked in at about that 6% rate, for a variable mortgage. So let's use that number right now. Let's see how this works for our investment, and then we can manipulate the numbers to see what's best for cash flow and gives us some security as well. So assuming that this is a one-bedroom in Kits, I'm going to put a market rent of about $2,500. So now we have the property price, we have our income. Now we have to look at expenses. So as a landlord, you're going to be covering the annual property taxes. So they're going to be approximately $1,900. Insurance is $80, and your strata fee is going to be around $330. So again, these are just estimates to give us a cash flow. It's going to be in the ballpark of some of our expected numbers. And all we want to do is see if our cash flow is positive, neutral, or negative, and how we can adjust those numbers to make it cash positive. So some of our fixed expenses are going to be nearly $7,000 a year just to cover property taxes, insurance, and strata. But when we get into the cash flow of it, right here, we're going to see that with $2,500 a month, we're going to be bringing in $30,000 a year. After our operating costs, which is the insurance, strata fee, and property taxes, we're paying $6,800 a year. So we're left with a net operating income before we pay mortgage principal and mortgage interest of $23,180. Now, we have our mortgage calculation. So with our mortgage calculation at 6%, let's flip the screen, our monthly mortgage payment is going to be $2,147. We have our additional expenses here, and our rental income is $2,500. So ultimately, the way the mortgage is going to be broken down at 6% is $1,782 is going to be allocated to your interest, and $364 is going to be allocated towards your principal, meaning that every single month we're going to have to contribute an additional $215 into this investment. So not the worst scenario, definitely not the best when you're paying out of pocket even more, $2,500 a year to cash flow the property. So let's see what happens here. And this is an important factor in today's market, is that when we do have high interest rates, what we want to do, especially as an investor, is make sure that we're buying into an area that is growing and essentially gentrifying, or there's going to be construction projects or new businesses or a lot more development coming into the area, because then we can forecast more appreciation. So right now I've estimated that appreciation, while this is a conservative number, will be approximately $815,000 in 10 years' time. So given the numbers, given that we are in a deficit every single year, does this investment make sense? Well, right now we're only making 4% a year. So not super strong numbers for an investment property at 6%. But if the interest rates actually came down to even 5%, let's see how that actually changes the scenario. Because now at 5%, right away, we are cash positive. I mean, it's marginally positive, but at least we're trending in the right direction once interest rates start to come down. Now, if interest rates come down enough to about 4%, now instead of paying $2,500 a year extra just to float the property, we're earning $2,500 a year before taxes. And then our accountant can get it and manipulate the numbers again to see how much we can pay in taxes. But you can see how much interest rate really affects the purchase and the strength of the purchase and how much money you need down just to cover the cash flow. But let's check out one more thing here. Let's put the interest rate back to 6%. And then we realize that we're going to be negative $2,588 not every year, but for the first year. And let's see how much we need down just to float that because of the higher interest rate. If we were at $350,000 with a $311,000 mortgage, then we'd be positive. So as an investor, you have to decide, do you want to put that extra $50,000 down into the property? That means the money is now back at the bank. You can't use that money unless you're going to take it out in the form of a line of credit. Or do you want to keep that money in your bank account? So put back $300,000 as a down payment, keep the $50,000 in your bank account just in case, the tenant doesn't pay, the tenant causes some damage, you need some repairs and maintenance, or you have a couple months there without rental income. That can be your safety net. So you can see how we can manipulate the numbers very quickly to see what you need in order to cash flow the property, but also how to create a healthy buffer that as a landlord will alleviate your stress and anxiety, which is ultimately, can you sleep at night? That's probably the most important thing. The one thing I forgot to mention here is that with the one bedroom property, we are assuming that we're putting down $300,000 and assuming we sell the property in 10 years time for $815,000, which isn't too unreasonable given the amount of immigration we have and the appreciation in the neighborhood. After all fees, taxes, capital cost allowance taxes, capital gains taxes, we're assuming that we're going to be turning that $300,000 into $454,000 after everything's all said and done, and that's even taking a loss every single year. So the next scenario I want to look at is house hacking. And I had a client in the past who decided to use this method to help them not only get into the market, but then use the property as an investment vehicle. And so what they've decided to do was live in the laneway of a house and then rent out the main house to tenants to help them fund the property and also use it as an investment vehicle. So in this scenario, the purchase, and this is something that we help them with to decide if this is a good investment, are they comfortable with the numbers? What would it look like in the future? And we looked at the numbers for every single property that we looked at. It only took about 5 minutes to plug in the numbers and see if they would work for my particular client. So this property was $1.9 million. They definitely have to pay the transfer tax of $36,000. They decided to put down $800,000. So they're carrying a mortgage of 1.1. And they were fortunate enough to lock into a fixed term of about 5%. When we look at some of the expenses, for property taxes were $5,000. Insurance was approximately $150. There was no strata fee. The water sewer tax, let's estimate that at $1,500. Gas was going to be shared. Hydro was going to be put back onto the tenants as well. So your expenses are not too dissimilar from that of a condo. The one-bedroom condo we were looking at had about $7,000 in expenses, and here we are with a detached house at $8,300. So the rental income, they had a top floor of the house, which was a 3-bedroom suite, and they were able to rent it out for $4,000. And there was also a 2-bedroom basement suite that they were able to rent out for $2,500. Now, my client lived in the laneway house, and she's paying off the laneway house and the balance of the mortgage. But every single month, she's bringing in $6,500. So every year, this house is paying her $78,000 for her to live in the house. Now, what does that mean for her monthly costs, and how much does she need to contribute every single month into the mortgage? So after expenses, her net operating income is just under $70,000. After interest of $55,000 a year and principal of $16,000 a year, my client is only paying $3,000 a year to live in a detached house in Vancouver. Now, we can manipulate this a little bit more. Does she need to put $800,000 down? No, that's actually quite a substantial down payment. So let's say we put down $600,000. And now my client is paying $15,000 a year, ultimately, to live in a detached house in Vancouver. So my client effectively is purchased a detached house in Vancouver for less than the cost of rent of a 1-bedroom. That's pretty remarkable. Now, of course, she needs the down payment to do that, but the numbers speak for themselves, and there's a lot of opportunity out there to get into a property that can help pay for itself. Sorry, guys, the one thing I wanted to say here is that with the house hack, yes, we're putting $600,000 as a down payment, but in 10 years, what does this mean as a long-term investment vehicle? So with that $600,000 down, we're effectively collecting the rent, paying down our mortgage, and we are turning that $600,000 investment into nearly $1.2 million, assuming a sale price of approximately $2.5 million. You pay all your capital cost allowance to the government, you pay real estate commissions, you pay the lawyers, like you pay everything. And we're still looking at turning 600,000 into 1.2 million. So we're nearly doubling our money. So if you want to get in touch and talk about an investment property, getting to a 1-bedroom, 2-bedroom, a duplex, house hacking, how we can manipulate the numbers and make it work for your situation or how much down payment you have, get in touch, click the link in the description below. Let's have a chat about how we can make this work for you and ultimately get you into a good position to retire in 20 to 30 years.